Greetings and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their stakeholders re-domesticate out of volatile legal and tax environments like the formerly golden state of California to a more predictable pro-entrepreneurship, pro-growth jurisdictions. Today, we are reviewing a recent report by Michael Taff, writing for the Financial Times, entitled California Billionaires Add Millions to Bolster Fight Against Wealth Tax. I will then conclude by explaining how owners of small and medium-sized businesses can use the same laws as Fortune 500 companies to their advantage to relocate their existing LLC or corporation out of California or another jurisdiction to a new state the right way, while keeping their existing federal employer identification number, contracts, bank accounts, track record, and credit history intact. But first, a brief introduction. My name is Professor Chad Daniel Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 12 professional licenses and certifications covering accounting, tax, audit, financial planning, and of course, the law. My firm website is www.cummings.law. The Financial Times reported on August 16th that California billionaires have put nearly 40 million additional dollars, that's fresh money, into the campaign against Proposition 40, the wealth tax measure on the state's November ballot, and which, in my estimation, is likely to pass. If you have viewed earlier presentations of Legal Bites, you know we have covered Proposition 40 in great breadth and depth. The measure imposes a one-time, although it will certainly not be one time if you listen to the brain trust behind the bill, but we'll stick with the script for now, a one-time 5% tax on the global wealth, not global income, global wealth of California residents exceeding a certain threshold. Now, if you watch earlier episodes, you know without a doubt that this is not something that affects only billionaires. Don't take my word for it. Listen to your California Congressman, Ro Khanna, who says very candidly when he joins Senator Elizabeth Warren in championing a federal equivalent that 2 things. First, this should not be a one-time measure. And second, the threshold needs to drop way, way lower such that if you are in the middle class, this is something you need to start thinking about. Again, earlier episodes, we went in much greater detail on that, but I digress. The opposition committee, called Building a Better California, received $10 million from the executive chairman of a blockchain company, $7.5 million from a prominent VC guy, nearly $1 million from another investor, and $250,000 from the founder of a growth equity firm. Now, those figures come from a campaign finance filing dated August 14th. The Financial Times also notes in its report that the measure has divided California Democrats and organized labor. Look at what that spending actually represents. These are people writing 8-figure checks for a chance that a tax might not pass, not a settlement, not an exemption, a ballot outcome over which they have very little control other than to spend money, which is decided by voters with no guarantee attached to any dollar spent. They are desperate, and I can certainly understand why. Now, compare that approach, which is certainly a risky approach, to an alternative available to every business owner in California. You do not have to open your checkbook and write a check to a campaign committee to change your tax exposure, nor do you have to persuade 40 million people. Instead, if you are a small or medium-sized business owner, you can simply change where your company is domiciled and where you keep your residence and where you conduct your business. And that is much simpler. This option is not limited to billionaires. It is arguably more valuable to businesses that cannot afford a lobbying operation. A company with no employees and a single owner can utilize redomestication just as easily as a Fortune 500 organization. Keep in mind, states like Florida and Texas impose no personal income tax, no wealth tax, and most small and medium sized businesses in these two states pay no business income tax either. That is a stark contrast. Neither Florida nor Texas has a measure on the ballot asking voters whether they should impose a wealth tax. In fact, the rules in those states are far more predictable and discernible, which is worth more to a business owner than any single tax rate. That is the real cost California imposes, uncertainty, and it does not show up on a rate table. Every 2 years brings another proposal, another ballot measure, another round of milking the cow to death. A business cannot plan around a tax code that is perpetually up for a popular vote. The people spending $40+ million this fall are doing so because they have too much fixed in California to walk away. Most business owners are thankfully not in that position. Instead, they can decide where their company lives and where they live, and they can decide it long before anybody starts counting the ballots. Now, with this context in mind, redomestication is the lesser known legal process of transferring a company's legal state of domicile, which is not the same thing as your personal residence, to a new state without dissolving it, without creating a new entity, and without triggering federal income tax, but only when performed with the strict formalities necessitated by the Federal Internal Revenue Code, applicable Treasury regulations, and the statutory frameworks of both the destination and departing states. Let me stop here. California absolutely permits redomestications for both LLCs and corporations. If somebody is telling you otherwise, they are way, way out of date. The law changed a long time ago to permit this. When redomestication is performed by a competent professional, the company retains its existing federal employer identification number, contracts, credit history, and bank accounts. That is to say, there is zero operational or financial disruption, but only if you get it right the first time. That is why it is imperative to work with a credentialed, experienced professional and save the DIY for home improvement. I have successfully completed redomestications from all 50 states, yes, including California, and for limited liability companies, partnerships, subchapter S entities, and subchapter C corporations. So if someone is telling you it cannot be done, what they are really telling you is they do not know how to do it. Now, foreign entity registration is not the same thing as redomestication because foreign entity registration, also referred to as foreign qualification among a miasma of other somewhat misleading terms, does not change the company's legal domicile. In fact, foreign entity registration does the exact opposite by keeping the entity in the former state, California in our example, indefinitely, in merely adding yet another layer of compliance and tax obligations in the destination jurisdiction, leaving you anchored to California generally and the California Franchise Tax Board specifically. No good. Meanwhile, a traditional merger, which is also not the same thing as redomestication, creates a new distinct entity in the destination state, may and often does require the issuance of a fresh federal employer identification number and can trigger serious tax problems. Finally, dissolution should not enter the conversation at all because dissolution terminates the company. Dissolution is a going out of business maneuver, not a relocation mechanism. Dissolution is often a taxable event, and to add insult to injury, can expose the owners of the company to unlimited personal, yes, you heard me correctly, personal, joint, and several liability for the company's liabilities, known and unknown. Hello, bankruptcy. That is because the so-called veil of protection no longer exists because the company no longer exists. If you think dissolution is a shrewd cost-saving maneuver, I encourage you to seek professional guidance before making a mistake you cannot undo with Control Z. Redomestication, when paired with the change of personal residency and that is a very important a reduction or outright cessation of business operations in California can reduce or even eliminate state tax exposure there for the entity and its owners. Don't take my word for it. ask your CPA. And if you get a blank stare from your CPA, well, it might be time for a change. Now is the time to consider acting before the California legislature in Sacramento considers changes to California law to hinder or even eliminate the avenue of redomestication. If you have questions regarding potentially redomesticating your existing LLC or corporation out of California or out of another state, please utilize the link in the description or in the bio for more information on this nuanced process and to schedule time for you and I to speak one-on-one about your specific scenario. Again, my name is Chad Daniel Cummings of the firm Cummings and Cummings Law, and I hope that you found this information helpful, if not somewhat distressing. As always, the information in this presentation, like all of my presentations, is necessarily general in nature and is not legal or tax advice, nor should it be construed as such, because that advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier presentations on this topic, please visit my firm website at www.cummings.law, not .com, but .law to schedule time for a consultation. I look forward to that opportunity to speak and perhaps even work with you very soon.